Hi everyone, and welcome back to Financial Basics. Today we're going to be talking about starting your investment journey. So the first thing you want to do is you want to just look at your personal circumstances. You want to make sure that you're cash flow positive. You want to understand what a broker is and the different fee structures that they charge. You want to have a good idea on what you can actually trade once you have a broker account set up. What is an investment? Avoiding get rich quick. And then the number one rule to building wealth in the long run, obviously, is to just get started and be consistent. So looking at your circumstances, you want to get a very good understanding of your overall financial and debt situation. If you have tons of debt, being able to invest becomes very difficult, and being able to invest consistently. If you are living paycheck to paycheck, I would not recommend starting investments. I would be very hesitant to do that. And the other thing is, if you are living paycheck to paycheck and you don't have sufficient cash over the long run to make an investment every single month or persistently with your income, then it becomes very difficult and very risky to make any sort of long-term investments. Your emergency fund. So if you do not have an emergency fund, you become very much at risk of potentially digging into your investments at a very bad time. So for example, if you don't have an emergency fund and your car breaks down, you might need to sell some of your investments. If you lose your job, you might need to sell some of your investments. And if you lose your job and the economy is down, you're selling investments when your portfolio value is down, and that's a bad time to sell. So overall, a very bad idea to go into investing before you have a fully funded emergency fund. Then you also need to just look at your obligations. So you need to look going forward, is your car needing repairs or maintenance or even replacement? Are you planning a holiday or a wedding in the future? Are you planning on having children in the future? So there are a lot of big expenses that you can foresee. So those come up in this context where you're going, okay, I'm going to not invest right now, or I'm going to pause or make sure that my investments are reduced such that I can deal with those other foreseen expenses. And then you also need to just make sure that you're hedging yourself against both your job and the economy. So looking at it from the perspective of, if you lose your job, what happens? And if you don't have the emergency fund and your economy and the economy is down and your company is struggling and you lose your job, it's a really bad situation to find yourself in, where that's the moment where you actually need to dig into your investments. So cash flow positive, what I mean by that is you need to be looking at a time period of maybe 3 to 6 months, ideally 12 months, if not over 12 months, where you are living below your means. And you can do this calculation across any time period, where you're simply going, how do I calculate my expenses, your bank balance across all of your accounts at the end of a period, at the start of a period, and you subtract your salary or your income during that period, and you can derive your expenses just using those three numbers. Once you have determined what your expenses are, you can compare that to your salary, and you can go, okay, am I actually cash flow positive over the last 3 months, 6 months, even a year? It's a very easy calculation to do. You just go back into your bank statements. So what is a broker? A broker is just an independent company or person that executes financial transactions on your behalf. It's the middleman between yourself and the markets. And they normally do this across a number of different assets or investments: stocks, forex, real estate, insurance, you name it. There's probably some type of middleman, and they normally charge a fee or a commission. A couple of examples of brokers in the UK: Vanguard, iWeb, Interactive Investor, Trading 212, IG Share Dealing. All of these are brokers. There's also a register in the UK for brokers, register.fca.org.uk. the FSCS also makes sure that if any broker goes bust for whatever reason or shuts down, then at least you have some level of protection against your loss. Obviously you will need to investigate that if it ever happens to you, and you need to, my advice would be speaking to an attorney or speaking to a financial advisor on the consequences or circumstances surrounding that. So there are different types of fee structures that brokers charge. So for example, a percentage charge, Vanguard does this. They charge 0.15% at the time of this recording, up to £250,000, and this is 0.15% of your overall portfolio, and then they cap that at £375. This can be expensive depending on the value of your portfolio, but it is good for small portfolios. Then you get your flat fees. So they normally charge a specific number or a specific amount, and that's normally pitched or sold as an annual fee or a monthly fee or an admin fee. So it's like $4.99 a month or $11.99 a month, whatever the case may be. And then normally on top of that, they have some type of combination of free transactions, i.e. you get 2 transactions per month with that, or you get 2 free trades or whatever the case may be per month with that admin fee. And then you get your trading accounts. So these are normally designed for high frequency people or trading, where you want to buy and sell and you're trying to not invest and forget it for like 20 or 30 years. You're actually thinking more, can I make money on a trade, right? Can I buy it now at a low and sell in a week's time at a higher price, or even later today at a higher price? This can include, or these types of accounts can also include more speculative investments. You can also trade on margin, where you're loaning money in addition to the capital that you're putting in, which is a much higher risk. These accounts are normally inundated with information, so you get a little bit of information saturation, where they're trying to inundate you with buying signals and selling signals and giving you all of the necessary information to make you feel like you are sufficiently informed to be able to make a trade or buy or sell an investment. And then finally you get the free accounts, where there are no percentage charges or no flat fees, and what they're doing is they're basically earning income on the difference between the price that they charge you and the spot price, or the price that they can buy it at on the market and sell it to you at. So they don't explicitly say this is what we're charging you, but that's built into the difference between the spot price and what you're paying. So they're hiding that fee inside of the transaction. Most brokers are going to charge some type of blended fee, and the reason for this is because a blended fee allows them to lower the price across all of the different options. So you can end up with a lower custody charge or a lower transaction fee, or a lower monthly fee, in the sense that overall they're still making a decent amount of money, and you're not seeing those costs as a single cost. You're seeing them as a little bit here, a little bit there, a little bit there. So they're breaking those costs up for you. So the way I look at transactions, and I think this is really important, is I look at, especially if you're investing in the long run, if you're investing for 20 or 30 years, what you want to be doing is you want to be working out the time value of the money, or the time value of the cost. So yeah, for example, if you're investing £1,000 and it's $9.95 for a transaction, then you can work out what percentage of that is the actual cost. So here, for example, it's 0.995%. You divide that against your expected return. So if you're expecting a return of 7%, use that. If you're expecting a return of 9%, use that. For the example here, I've just put in 8.5%. You should be getting at least 8.5% over a long run in the market after inflation. That's your real return, and you can work that out as 0.11705 years. That's about 1.4 months. So the first 1.4 months you are paying for the transaction fee. After that, you'll be making money, you'll be making profit. That's your break-even point. And then obviously, if you invest a bigger amount, at least for the flat fee, you can see here 995 divided by 5,000. Okay, now we're talking about 8.5 days or 0.28 months. Then you can look at it. You can also look at the percentage charge in the same way. For example, if you have £1,000 and you have an ongoing fee of 0.05%, then you're looking at a cost ratio, and you can just work that out on a £1,000 investment. So you're talking about 50p per year, 50p against your 8.5% return, your £85, and you're looking at 0.58% of your return. 0.58% of the 12 months is 0.069 months or 2.11 days, which is a very short period of time, which means your break-even point is about 2 days if you want to spread that cost over 12 months. There are also additional costs, so I think this is also worth mentioning. Normally funds have expenses that are built into the management of the actual fund. This is separate to the broker, but it is worth noting. So normally they're going to charge 0.015% or 0.05% of the actual value in that fund. So if you've got £1,000 in there, they're going to charge you 0.02% of that. These are good examples of low cost index funds. So what you can trade once you have a brokerage account set up, you can obviously keep it as cash in the broker account. You can also trade or buy equities. You can also buy funds that follow the stock markets, follow what equities are doing across different markets. You can also invest in fixed income assets such as bonds, which is fundamentally you loaning money to either companies or government. And normally you'll get a percentage based on the value of the bond. You can also invest in commodities like gold or silver, and then you can also invest in property. So for example, through a REIT or a real estate investment trust. So what are investments? And this is a little bit of a hot topic, but I lean very heavily on the definition, at least according to Warren Buffett, which is it needs to generate income and it needs to be well diversified. So what you're looking for is a track record of at least 30 years, if not more, where your investment will survive those 30 years. And you need to be thinking about this in the context of it might be another 20 years before I retire, and once I retire I might need that investment to continue to perform for 30 years, if not more, after I retire. So the next question is, does it beat the market? Am I getting a return of at least 8% per year? That's right now, but obviously that changes with general market conditions. But you want to be beating the market on a regular basis, or at least matching the market. And does it beat the risk-free rate? So the risk-free rate is simply interest rates. So what are interest rates at the moment, and are you beating that? And then, is it well diversified? You don't want to have all your eggs in one basket, especially if this is your entire portfolio. This is everything that you have. And in my opinion, and this is just my opinion, things that aren't investments, they're not generating income. Crypto, you're fundamentally hoping that somebody pays more for this later from you and buys it from you. Single shares, the problem here is again very limited diversification. And I'm not saying they don't generate income. I'm not saying that you can't invest in single shares. I'm just saying they're not long-term 50-year down the road investments. Same with property. The biggest challenge that I see with property is a lot of people say, oh no, I've got 10 properties, so it's well diversified. There's income generated every month because everybody's paying rent. But the challenge here is you are still a lot of the time exposed to things as simple as all of these properties might be concentrated in a single city. So if you've got 10 properties all in the same city, if there's an earthquake in that city, you might be in trouble. If there's a flood, you might be in trouble. If laws change, you might be in trouble. So there's a whole bunch of things in a property portfolio that you need to take into consideration when it comes to diversification. Having multiple properties in multiple locations, i.e. different countries, different cities, then you could start to argue, okay, this is actually a fully diversified portfolio of properties. The other big one that I see and I need to often discuss is just company stock. A lot of people say, oh no, I've got 600,000 in my company stock because I've been getting a discount. I've been buying it at 15% discount or 20% discount through my company. I work there. But the question then you need to be asking yourself is, what happens if your business fails? What happens if the company you work for fails? Well, you're going to be out of a job and your portfolio, your retirement part, is going to be worth nothing. And what do you do then? Then you are in full-on crisis mode. And the challenge there is stay diversified, keep thinking about diversification, and do everything in your power to actually hedge against your company stock. So even if you have some of your portfolio in company stock, that's absolutely fine. Just make sure it's not the majority of your portfolio. And then of course cash. Cash is an asset, but it is not an investment. It does not grow, it actually decreases in value because of inflation every year. So you want to make sure that you are managing how much cash you have, but it is not an investment. And then the number one rule to building wealth. It's really, really simple. All you need to do is start. Make sure that you are in a financial position where you can invest. And to do that, all you need to do is look at those basics, assess yourself financially. Choose a broker, any broker, and then start investing. It really is that simple. And a lot of people come back to me and push back on this and they go, no, what about tax efficiency? What about making sure that I lower my investment costs, or using multiple brokers to try and be smart about what to invest in and how to invest in it? Or, I've got to buy crypto. They're looking for get-rich-quick schemes. They're looking for things that are too good to be true. And it's really simple. If you want to do long-term investing, these are the things you need to be doing. Just start and be consistent. In summary, starting your investment journey can actually be really simple. It doesn't have to be complicated. And start with what you can spare. Start with what you have available. Do a realistic assessment of your financial situation and then start at that point. I personally started with a really small amount because I was unsure when I started, and I just gradually increased it every month. In conclusion, if you liked this content, please support my channel by liking, subscribing, and sharing. It really helps the channel. If there's anything I missed and you would like us to cover, please comment below. And if you want to discuss the financial situation or a specific financial circumstance, or even just a question, you're also welcome to email me at financialbasicsabc@gmail.com. Thank you for listening and see you next time.